Crypto is at its best. It's a new financial system that's being built from scratch.
So do you envision a future where decentralized finance and traditional finance coexist symbiotically, or will one system eventually dominate over the other? Welcome everyone. We have Byron Gilliam, the market strategist at BlockWorks. Welcome to the show.
Thanks for having me on it.
I feel that we're still at a point where decentralized finance and traditional finance are two separate worlds.
Larry Fink says that everything is going to be tokenized. I think that would be really fun. If you could trade equities on public blockchains, that would be neat. If you just put all of equities on blockchains, really it's just kind of like better and cheaper bookkeeping.
Markets are driven by human behavior. There's fear, there's greed, there's FOMO, there's panic.
I just think that financial markets are so much a function of behavioral psychology. People in crypto are humans, people in TradFi are humans. So they fall into all of the same behavioral finance traps, whether they're trading crypto or equities.
This is The Blonde Dollar with Ignacio Ramirez.
Welcome everyone to a new episode of The Blonde Dollar. We have the great pleasure today of hosting Byron Gilliam, the market strategist at BlockWorks. For those of you that don't know him, Byron is the writer of the BlockWorks daily newsletter, where he makes super insightful and witty analysis of crypto markets and traditional finance. Before joining BlockWorks, Byron spent 25 years trading global equities across major financial hubs such as Frankfurt, London, Paris, and New York. And we absolutely wanted to have him on the show because his extensive experience in traditional finance provides him a unique perspective on the intersections between the established financial systems on one side and the emerging decentralized technologies and the world of crypto. As you can imagine, in today's discussion, we'll delve into Byron's journey, going from traditional finance to crypto, but we'll also gain insights into the intersection between these two worlds. Byron, welcome to the show.
Thanks for having me on. I appreciate that super nice intro, and I especially appreciate you reading the newsletter.
We'll talk about that in a few minutes, but to start with, can you tell us a bit about yourself and what is it that you do at BlockWorks precisely?
So I write a daily newsletter about crypto for BlockWorks, which is a crypto media firm. They asked me to write it because at the time, about 3 years ago when I started, they were looking for someone who could explain crypto to traditional finance people. And they thought I could do that because I was a traditional finance person. I didn't know very much about crypto at the time. I knew like Bitcoin and ETH, and that was about it. So I've been trying to do that which is, I've been figuring it out as I go. So the newsletter is kind of me explaining crypto to myself, which I think has been helpful for people. And then I find myself also explaining traditional finance to crypto people. So I kind of try to sit in the middle of the two and try to explain each side to the other.
I'm always puzzled when you say that you didn't really know much about crypto a couple of years ago, because your newsletter is so freaking good. I'll be honest, there's 3 newsletters that I read religiously every morning. One is John Authors on Bloomberg. Another one is Robert Armstrong on Hedge on DFT. And you're the third one. I'm not a crypto expert, but the way you bring market stories from traditional finance to explain things happening in the crypto world is just amazing. I mean, it's absolutely crazy how good you're at that. And yeah, I'm always wondering, I guess my first question for you is writing this daily newsletter. It's not an easy task, especially given the amount of depth you go into. And of course, some of the topics you select resonate, others fall flat. Sometimes the things that you thought would be a throwaway line ends up being the most talked about part of the newsletter. So I guess my question for you is, how do you select the topics for your newsletter? And what feedback has influenced you the most in your content direction since you started?
How I select the topics, I don't have any real process. I think basically what I do is just write about what's interesting to me and then hope that it's interesting to other people. I kind of think that's the only way to do it, because if I'm not interested in what I'm writing about, then it's not going to be interesting to read, right? I enjoy financial history and business history, and I'm old enough so that I remember a lot of it. And so that's kind of what I wind up talking about, and it seems to resonate with people. I think it's a good way to understand crypto also. Like, crypto is at its best, it's a new financial system that's being built from scratch. So I think it makes sense to try to understand it in the context of financial history. And then for the second part of the question about what feedback I've had, I don't know, I think probably the feedback that I've taken most to heart is that people seem to like it when like I talk about personal stories, like my old trading stories from the 1990s or something like that. And also just generally when I kind of express an opinion, not like hot takes and stuff like that, but just kind of like personalized opinions. So like when I'm just kind of being myself, people seem to like it, which I really appreciate, because that makes it more fun to write.
Yeah, I mean, for sure, I can say as a reader that I love when you bring stuff from the early 90s. I mean, you've been a trader or trading at least equities for around 25 years, which is obvious, of course, no joke. You've seen markets change, you've seen rules change, regulations change, and the whole industry transform. So maybe another question I had for you was, like, looking back at your trading days, was there a defining moment that really stuck with you and the way you approach financial markets?
I don't think so. I mean, I traded through the .com crash and through the great financial crisis. So those were, formative experiences for me. I'm not sure I actually learned anything useful from them. Jim Grant, the financial journalist, he's got a line about scientific knowledge being cumulative and finance knowledge being cyclical. The idea being that like nobody ever learns anything in finance. You have to relearn everything. Like the .com bubble was the same as like the railroad bubble. Like the railroad bubble in the 1880s. If there was some science discovered in the 1880s, you wouldn't have to rediscover it in the 1990s, right? But in finance, you've got to go through the same thing every 30 years or something like that, collectively. And I think that's true for me personally also. Like, I have to relearn not to buy bubbles in every single bubble. So maybe that's a lesson. Maybe the lesson is that there are no lessons.
Yeah, I think that's spot on. The one sentence that resonates with me around the same topic is that markets have short memory. So I feel like we do learn the lesson, but then we forget about it, which is the same as not learning, I guess.
There's also there's a great line from Stanley Druckenmiller also about in like 1999. He had been short tech the entire time, the .coms, and then like at the end of 1999, he flipped long and just got completely blown up. And talking about it afterwards, he said, somebody asked him, like, what did you learn from that? And he said, I didn't learn anything, because I already knew I wasn't supposed to do that, but I did it anyway.
Why did he do it then? Gosh.
That's the cyclical nature of financial knowledge, I think.
Yeah, and that's, I guess, the beauty and the curse of financial markets, right? Like, I feel whenever there's like a new breed of investors and analysts and so on, they have to experience these things by themselves. Because it's kind of annoying sometimes when you hear people that have been in the industry for like 30, 40 years saying, oh yeah, but you didn't live through the 90s or the 2000s and this and that. And you kind of think to yourself, well, like, there's other things happening now. And then you actually get to experience some of those volatile periods, and then you understand, oh, okay, that's what they were talking about. I mean, yeah, I guess there are some lessons to be taken from that, and some of the things that happened back then are happening now. So for sure, there is value, because history has this tendency of repeating itself in some way. what is the sentence? History doesn't repeat itself, but it tends to rhyme. So I think that's I think that's very, very spot on. But going back to your newsletter, like we were saying that you have this way of making experienced traditional finance professionals sometimes feel like interested in the crypto world that they maybe don't understand fully, but also by reading your newsletter sometimes they feel, or we feel, a bit like beginners, because there's the jargon, there's the tech, there's all this constant innovation in decentralized finance, and it's a little bit easy to get lost. But as we were saying, I think you're really good at bridging that gap with your writing. From all these dailies that you've written, what are the challenges that you faced in making the decentralized finance concept understandable to those coming from a traditional finance background? What is the hardest thing to make them understand?
Yeah, I guess I don't really think about it that way. I really just think about trying to understand it myself and trying to, express things in a way that it makes it clear in my own head. And then I hope people come along for the ride. It is difficult because my audience runs the entire spectrum from crypto native to, crypto newbie. So it's hard to know how to, how much of the jargon to explain and stuff. I lean on I lean in the direction of not explaining the jargon, because it just kind of makes for boring reading. And I know I lose some people with that. So it's kind of, I have to strike a better balance, I think. But, the newsletter is like 1,000 words long every day. So if I explained it right down to the nuts and bolts, it would get would start reading like an instruction manual to set up your VCR or something like that. So I don't know. That's a tricky one, but I generally just try to make it clear to myself and hope that people will appreciate the effort at least.
That's pretty cool. And you're basically your ideal customer persona, and you just write what you want to read about. And turns out that a lot of people are also interested in the same thing. So it's a win-win. That's pretty cool. I want to ask you another question about this transition that you made, because obviously going from trading equities to writing about crypto is quite a shift. Most people wouldn't wake up one day and think, hey, you know what? I'm going to become a crypto newsletter guy. So my question is, what motivated you to shift from traditional finance after more than 2 decades working in there to becoming a crypto newsletter writer at BlockWorks?
I didn't really plan it out. It was just kind of something that happened. I'd kind of aged out of trading. It's kind of a young person's game, and also trading is not as fun as it used to be. Trading in the 1990s was super fun. And then in the early 2000s, the algorithms started to take over. Before say 2005, I would say, when you were trading, you just had to be a little bit better than the next guy. And by 2010, you had to be better than a machine, which is impossible, really. So the job wasn't, got decreasingly fun, for one thing. And two, just for personal reasons. I had moved to North Carolina and was kind of poking around looking for something new to do. And this is like the boringest crypto origin story of all time, but I just clicked on a LinkedIn job ad for BlockWorks and replied to it. Sometimes I think I need to make up a new origin story. But I think
No,
it's actually,
good.
I think my LinkedIn story is actually so banal that it's interesting. And I think it tells you something about crypto, is that crypto being still very new, you don't really have to know anything about it to contribute. You can just jump in even now. That was 3.5 years ago, 3 years ago. You really didn't need to know anything. But even now, I think you can jump in and contribute without really having any prior knowledge, which is very different than traditional finance.
Yeah, that's interesting. Yeah, kind of being a new asset class levels up the whole thing. Everyone is a beginner pretty much. these assets haven't been around in previous financial crises and so on. So everyone is learning along the way.
Yeah, I think that's what makes it fun and interesting, I think.
Yeah. I'm also, as you know, a big LinkedIn fan. So thumbs up for LinkedIn for finding your job. You can find a new job via LinkedIn. So cool stuff.
Yeah. I think that was also the first job I ever got that wasn't from somebody that I knew, like, which was different for me also.
Nice. So I want to talk about, again, now we're gonna bounce to the part of the conversation where we're gonna be comparing a lot traditional finance to decentralized finance, because I think really that's where you have a unique perspective and great stories to share. So starting with market psychology, you know as well as anyone that markets are driven by human behavior. There's fear, there's greed, there's FOMO, there's panic, and what I've noticed is that decentralized finance and traditional finance and the investors in there don't always behave the same way. So obviously, DeFi, decentralized finance, move at super high speeds. A lot of times they're fueled by speculation and memes, whilst traditional finance has all these guardrails, circuit breakers, and of course, institutional players that usually bring stability. So I want to ask you, because you spend time in both worlds, how does investor psychology differ between traditional financial markets and the emerging decentralized finance space?
No, that's a good question. I mean, I guess two things spring to mind. One is maybe the very first newsletter, I don't know, in the first week or something, I wrote a newsletter about option smiles, which I know is kind of technical, but basically in equities, puts are always more expensive than calls. Like out of the money puts are always more expensive than calls, and that's because people use options to hedge their downside. Like everyone is naturally long of equities in their retirement accounts or their hedge fund or whatever. So the purpose of options is to hedge your downside in case something goes terribly wrong. And in crypto, one of the first things I noticed was that it's the opposite. Call options are more expensive than put options, which was like almost disorienting to me. It just looks so weird. And I just figured out that that's because like nobody's hedging their downside in crypto. Everyone is hedging their upside, if that makes sense. Or, they're using options. Well, they're not using options to hedge. They're just using options for leverage because crypto people are so excited about crypto that it's not enough just to be long. They have to be levered long. So I think that's like a real difference in psychology. Other than that, though, I would say there's more similarities than dissimilarities, probably. I just think that financial markets are so much a function of behavioral psychology. And, it's, people in crypto are humans, people in TradFi are humans. So they have all the same, they fall into all of the same behavioral finance traps, whether they're trading crypto or equities.
What is the most common human behavior bias that you've witnessed in crypto?
That I've witnessed in crypto? I don't know. I don't know. I would have to think about that one. Like the classic one would be the unit bias, where people on TikTok or whatever will get excited about buying a crypto because it costs 1/100th of a cent or 1/1,000,000th of a cent or something like that. Instead of, a crypto that costs $10 or something, or they think that ETH is cheaper than Bitcoin because Bitcoin trades at 100,000 and ETH trades at 2,000. So I don't know. That's one that springs to mind.
The one that comes to me is obviously herd behavior and FOMO.
Oh yes, yeah, FOMO. Yeah, FOMO is yeah. I mean, FOMO is universal, but it's probably more pronounced in crypto than it is in equities even now.
I loved what you were talking or what you were explaining about the smile, because I'm a fixed income guy. I'm a fixed income advisor, and I tend to look at my asset class as a good complement to more volatile asset classes. that historically, have been used by investors to add, let's say, more alpha to portfolios, such as equities. Whilst now with the arrival of crypto, like equities is almost like the conservative part of the portfolio of a lot of investors, and they look for that alpha via this emerging asset class. So I guess the world is changing. So right now, I feel that we're still at a point where decentralized finance and traditional finance are two separate worlds. One is open, decentralized, and experimental. The other is very structured, very heavily regulated, and deeply entrenched in the global economy. But there's a growing conversation about whether these two worlds, these two systems, can actually work together or not. So do you envision a future where decentralized finance and traditional finance coexist symbiotically, or will one system eventually dominate over the other? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Yeah, I don't know. I go back and forth on that one. Larry Fink says that everything is going to be tokenized. And I think that would be really fun. If you could trade equities on public blockchains, that would be neat. And there's things that you can do with tokenized securities that you can't do with equities. Like, you can use them for collateral, borrow against them. You can stake them and get extra dividends and things like that. But I don't know, if shares are tokenized, they're still going to be fully regulated, and you're still going to have to be KYC'd to trade them. So if you just put all of equities on blockchains, really it's just kind of like better and cheaper bookkeeping. So that's not super exciting to me. It could cut costs a lot. And there are people going in that direction. Just yesterday I spoke to the guys from Prometheum, who are very controversial in crypto, but they're building a fully regulated exchange for crypto securities, so things that are registered as securities. So it's possible we go in that direction. I kind of think though that they're just going to develop in two different directions, and in DeFi, the things that are interesting are things that have been created natively, not bringing real world assets on chain, but just new assets that have been created within the crypto sphere, and that just trade on their own. But then, on the other hand, that probably is not going to be unregulated forever either. So I don't know. Yeah, maybe it will just end up in a big kind of mushy middle somewhere.
Yeah, I have a hard time thinking that any of the two will dominate over the other, quite frankly. But what I find interesting is that over the time there seems to be more and more institutional adoption, right? Like some time ago, no one wanted to talk about crypto from the big financial institutions, and now it seems that more and more people are opening up to the idea of having something to do with it. So I'm really curious to see how that evolves.
Doesn't seem like the institutions have gotten very far past Bitcoin as of yet, and mostly they just own ETFs of Bitcoin. I think it'll be interesting when crypto develops some native assets that are unique and attractive enough that it forces traditional investors to participate, because they just feel like they can't miss out. That would be the real institutional adoption, I think. Like Larry Fink's vision of bringing existing securities on chain, that's not super interesting to me. But if crypto natively develop some assets that are genuinely good investments, and that forces institutions to come on chain, that's what would be interesting.
Yeah, I'm looking forward for that. And obviously, I'm also really curious to see how the topic of liquidity pans out in this whole thing. I'm a fixed income person, and liquidity is, of course, incredibly important for bonds, given that it's an over-the-counter market, as you know. So yeah, I would argue that in traditional finance, liquidity is everything. Keeps markets moving and supports investors' confidence to be able to get in and out of any position. But in the centralized finance, I have the feeling that liquidity works a little bit differently. It's more fragmented. It's sometimes reliant on certain incentives, and more importantly, it seems to sometimes disappear overnight if those incentives dry up. You wrote about this, I think, in one of your dailies called "Cash is Still King." So, question about liquidity: how does the role of liquidity in decentralized finance compare to its function in traditional financial market?
Yeah, I guess there are two different kinds of liquidity, maybe, or two different issues in liquidity in crypto. There's the centralized exchanges, which look and feel like a traditional equities exchange, except that the liquidity there is very fractured. So, Bitcoin can trade at one price on Coinbase and at a completely different price on Binance, which doesn't happen in equities. At least in U.S. equities, you've got the Reg NMS, where no matter where you place your order, you're going to execute on whatever exchange has the best price. And crypto is not like that. Crypto, the liquidity is fragmented amongst all of these centralized exchanges, which is just weird for a traditional person that, you have to think about what exchange you should be trading on. That's just very different. I think that's part of the reason why the traded volume numbers are like really inflated in crypto. Like Bitcoin trades like $40 billion or something a day, which makes it sound incredibly liquid, but some large portion of that is just people arbitraging between Coinbase and Binance and stuff like that. So it's not real liquidity. So anyways, that's the one issue, is the centralized exchanges, where the liquidity is much more fractured than it would be in traditional finance. And then there's the decentralized exchanges, which are, growing in market share. And those are mostly based on automated market makers, where the liquidity is passive. It's passive market making. And I think that really changes the way things trade. I think that makes things more mean reverting. Things can, go up more than you would expect them to, because the market makers are just passively providing liquidity. And then when people notice, then it reverts back to the mean very quickly. Feels like things just trade differently on decentralized exchanges for that reason.
Yeah, I think for sure, like, this is something that traditional finance people are looking at very, very closely. And if we want decentralized finance to be more widely adopted, liquidity has to be there in a stable and reliable way. Otherwise,
the one thing that crypto is good at is creating liquidity in the long tail of tiny assets, and that's because of the automated market makers. Like you can, there's a market for things immediately as soon as they start trading, even if it's got like a $300,000 market cap or something like that.
Yeah.
Which is not the case with equities, obviously. So maybe that's one advantage of crypto liquidity over traditional finance.
Yeah, that's interesting. And talking about, like those tiny assets on the tails, obviously there's been a lot of tokens that have been issued over time. And I wanted to ask you something about that. So if you compare tokens to stocks, it seems that they both represent an investment into something, but their fundamentals are very different. Stocks gives you ownership in a company with usually revenue and hopefully profits, whilst tokens, they can represent a lot of different things like usage rights, governance, or even just pure speculation. And how should investors approach valuation in some of these assets in decentralized finance compare to traditional finance? Are the models that we use in the traditional finance world applicable, or do we need completely
different frameworks?
I think they're very applicable, and I feel I've always thought they were applicable because I don't really understand how else you can think about valuing an asset other than as some net present value of its future cash flows or future dividends even. Like to my mind, even stocks that don't ever pay a dividend, still their intrinsic value is still the net present value of their future dividends. And I think you should think about crypto tokens that way as well, at least the crypto tokens that look more like businesses that charge fees and collect revenues, or at least will do sometime in the future, or theoretically should do. And I think I think people are coming around to that point of view in crypto, maybe just because there's more people coming over from traditional finance. I'm not sure. But people are talking about valuation metrics a lot more than they used to, and those valuation metrics are just the same as in traditional finance because there's no other way to do it really, except with the exception of meme coins where there obviously is no valuation. There's no value. There are no fundamentals to speak of at all in meme coins. That's clearly just a game. But for non-meme coins, the tokens of protocols that purport to do something, I don't think there's any way to value them other than using the same valuation metrics that people use in traditional finance.
Maybe new ones will emerge over time, but you got to start from somewhere, I guess. And talking about value and valuations, I wanted to ask you about investment philosophy. So value investing in traditional finance is huge and very well understood. You find an underpriced asset with strong fundamentals and you hold it for the long run. And in crypto, that of course is a little bit trickier because a lot of speculation is present, as you were alluding to. And most importantly, a lot of projects don't even have like proper revenue streams. So how do traditional investment strategies such as value investing translate into the decentralized finance space?
I think they translate like, one thing that I think is that most value investing in traditional finance is actually trading. So usually when value investors are talking, are giving their thesis for a stock, like they, like whatever refining company because it trades on 8 times earnings or something like that. Like usually what they want to do is they want to buy it on 8 times earnings, convince everyone that it's too cheap, and then sell it on 12 times earnings. Like that's not really investing, that's trading, right? It's just a, trading from a valuation perspective, which is totally fine. But it's maybe a little bit less Benjamin Graham, Warren Buffett pure theory than people make it out to be. And, in crypto, that's harder to do because there just are not that many cryptos that are currently earning, revenue. But there's an increasing number of them. And I think you can invest in crypto, from the perspective of what is this protocol going to earn over its lifetime, and how are those revenues going to come back to token holders? It's just harder because one, there's not that many that make revenue now, and two, everything is just really, really expensive. I mean, not literally everything, but most things, if you look at them from a traditional finance point of view, they're just inexplicably expensive, which makes you think, well, if I'm going to trade this, I've just got to trade it on momentum or sentiment or something, because the value is so far in the future, and so difficult to determine, that it almost seems not worth trying.
I think what is tricky with this whole thing is that speculation and bubbles are hard to measure or pinpoint, right? Because you never really are 100% sure you're in a bubble until the bubble bursts, I guess. And of course, traditional finance has had its fair share of hype cycles. We had meme stocks, we had SPACs, we had the dot-coms and so on. But decentralized finance has taken this to a whole different level.
even seen like projects launching tokens before they even had a product. But at the same time, some of, these tokens that have been launched eventually become valuable because there's something behind it. So I guess my question for you is, at the end of the day, what is it about decentralized finance that makes it more prone to speculative bubbles? Is it the fact that it's a new asset class and there's less regulation? Is it just the fact that it's still very new and there hasn't been widespread adoption yet? What is it?
Yeah, I think previous crypto bubbles were largely about novelty, like the original Bitcoin bubble was, it's just this new thing, and you can, when something is new, you can just imagine these blue sky scenarios. I think that was the same with the NFT bubble and the DeFi bubble. Where, like you said, it's just a function of the novelty. It's new, nobody knows what it's worth, so you can kind of dream that it's worth infinity. I think that's changed just recently, though, like just in the last few months even. I feel like this crypto cycle, and I shouldn't call them bubbles really, like Bitcoin is not a bubble, I don't think, because bubbles don't like continually reinflate, right? Bubbles generally, once they pop, then they're done, and then the next thing has got to be a bubble and something different. But if you have, if you continually have bubbles in the same thing, then it's probably not, an investing bubble. But crypto has a lot of like mini bubbles, and this most recent one, I feel like something has changed, and it's probably because it is so easy to create cryptos now. There are something over 30 million cryptocurrencies now.
Oh, wow.
Yeah, well, 99% of them are just ephemeral. They get created and they go straight to zero, and basically nobody ever trades them. But they're just so easy to create. And there's, Brian Armstrong at Coinbase the other day said that, they're looking at 1 million cryptos a week, like 1 million new cryptos a week, which is impossible for them to parse and decide what should be on the exchange.
Almost as many as new podcasts.
No, not that many. So I think what's changed is that it's become so easy to create cryptocurrencies, is that the bubbles come and go very, very quickly. Like we most recently had the AI agent bubble, which only lasted for like 3 months, which is, not a very good bubble. And I think the problem was that like the supply side can respond so quickly to demand. There was suddenly demand for AI agents, and the demand just there was just a tsunami of new AI agent tokens for people to buy, and it just squashed the bubble before it could really get going. So I think that might be a feature going forward in crypto, and something that makes it different from traditional finance. Like equities, if you really want a bubble, like there's got to be some exciting topic like AI, and then VCs have to invest in a bunch of money in a bunch of companies, and then they have to go through a few series of fundraising, and then they have to IPO, and people still have to be excited about the thing to buy the IPO. So like it takes a long time for a equities bubble to really get going. And there are, even now, like how many AI stocks are there to invest in? Like there's not very many, right? But in crypto, like the supply side, the supply of tokens can just respond instantly to whatever the hot topic is. And I think that might make crypto actually less prone to large bubbles, at least. Like it's prone to lots of little mini bubbles, but it might make it less prone to very large bubbles.
So talking about AI and hot topics at the moment, obviously AI is everywhere, both in traditional finance and in decentralized finance. You were saying that, every project is slapping AI powered on their decks. And of course, a lot of time the AI part is kind of questionable. But everyone, loves a good buzzword and jump in whatever narrative is dominating markets at the moment. But at the same time, I'm a big fan of AI. I think it can legitimately change the way the world operates. For sure, it's going to happen in traditional finance, and I can only imagine it's going to be the same in decentralized finance. So in the decentralized finance world, how do you think we can differentiate between genuine innovation when it comes to AI from just speculative hype? What are the really the use cases where you thought, this makes sense? I definitely, this is going in the good direction now that we're putting AI into it, compared to other use cases when you're like, okay, this doesn't make any sense.
I think crypto has matured to the point where you can start weeding things out according to the revenue that they generate. That wasn't the case until recently, probably. But there are enough projects in crypto where people are paying to use them, and that is maybe the ultimate indication that the thing is useful. If something is genuinely useful, then people are going to want to use it. And there are enough projects in crypto now where people are genuinely willing to pay money to use them, that I think you can use that as a filter that filters out almost everything. Like there's you can generally assume that whatever the latest topic in crypto, you can generally assume that it's hype. But there are a few things that are, attracting genuine users and charging fees, and people are willing to pay them. So I think that's probably the way to separate the substance from the hype.
That's it. So yeah, we're talking about hype, we're talking about bubbles, corrections. So I guess an underlying topic in all of this is risk. And I wanted to ask you about that too. So obviously, risk is everywhere in finance. Whenever you start your studies in university, they tell you about this famous equation that the higher the risk, the higher the potential return, of course, and that gets like ingrained within your brain. But it seems that the risk we're taking in traditional finance and in decentralized finance are fundamentally very different. So in traditional finance, a lot of it comes from central bank policies, from geopolitics, regulatory shifts, institutional failures, such as what we saw in 2008. While in decentralized finance, it's a completely different game. We're talking about smart contract vulnerabilities, protocol exploits, and the famous liquidity crisis that of things that can blow up overnight, as we were just alluding to. So they both have risks, the two systems, but they manifest in very different ways. And my question for you is, how do the risks in decentralized finance compared to the ones in traditional finance? What are the parallels that you've witnessed between the two, despite their very different nature? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
I guess not sure about the parallels. I guess the difference to me basically is that, in decentralized finance, I think the risks are mostly about self-custody, holding your assets in your own digital wallet. Like self-custody still gives me the heebie-jeebies. I hate it. And it stops me from putting any real substantial amount of money into crypto because I'm just, worried about phishing attacks or losing the piece of paper with my private keys on it or signing a transaction that I shouldn't sign. When you're doing something in decentralized finance, there's all these pop-ups. You're always signing transactions and you should look at them very carefully and make sure, but I don't have patience for it. So I just basically click every pop-up, which is terrible OPSEC. But I think that's the major security concern is the risks of self-custody. There are systematic risks also. I guess there could be a major bug in the Solana code or something like that. I think they call it is it 0-day bugs or something like that? Like there could be a bug in the Bitcoin code base or something, or the ETH code base that nobody has discovered yet. I don't really think about those because it seems pretty unlikely. There's also 51% attacks in crypto, which has never happened on a large blockchain, I don't think, so I don't really think about that. Quantum, maybe. I guess we can worry about quantum computers. And I guess maybe the parallel to traditional finance is, I guess I don't really think about the systematic risks in traditional finance either. I guess probably, the things to worry about would be the things that you never think about, like maybe, a major cyber attack or a solar flare that wipes out the electricity grid,
The black swans.
Black swans, or North Korea hacking the DTCC or something like that. But yeah, I don't know. I feel like they're all black swan enough that you can't even think about what they're, if you can imagine what they are, then that's probably not something you need to worry about.
And I wanted to ask you about something you very briefly touched in that answer, which was transactions and I guess that also the transparency and the anonymity of all of these. So one of DeFi's biggest selling points is transparency. Every transaction is on chain, it's visible to everyone, but at the same time, DeFi embraces anonymity, and you have all these pseudonymous developers, private wallets, permissionless access. And on the other hand, you have in traditional finance, completely the opposite. Like everything is about KYCs, anti-money laundering compliant, monitored by regulators, and so on. So my question is DeFi really more transparent, or is it just a different kind of opacity?
I think it is more transparent, and that is a feature and a flaw. Like I can't imagine that DeFi will really catch on with the mainstream without privacy. Like even just for basic payments, companies are not going to accept payments on a transparent blockchain where all their competitors can see exactly, what their revenue is or something like that. And big institutional investors, I think, are not going to want all of their transactions to be on transparent blockchains where people can see what they're doing. So for DeFi to go truly mainstream, it would need some level of privacy, but that's different than anonymity, right? Like I don't think that DeFi can be truly anonymous, or at least I don't think it will be. The anonymity wouldn't be accepted by regulators and stuff. So you could have a blockchain where everything is based on ZK proofs. Nobody can see what anyone else is doing, but everyone can confirm with a ZK proof that you are who you say you are, and you're maybe even that you're not a North Korean hacker or whatever. But I can't imagine that regulators are ever going to accept a ZK proof for KYC, because you'd have to be some kind of like PhD mathematician to understand whether it even makes sense. So I think there's going to be an issue probably over the next couple of years where there are genuinely, there are blockchains that genuinely preserve anonymity. I just don't think those will ever be accepted by regulators and law enforcement. So my guess would be that there's going to be some kind of fork in the road where there's, just like there's a dark web and the internet, I'm guessing that there's going to be like a dark crypto ecosystem and a public crypto ecosystem. That's not happened yet, but I feel like in the next couple of years that will probably be a theme.
So talking about regulators, there's this concept that I find interesting, which is regulatory arbitrage. So DeFi has this reputation of, in some instances, because it's so new, being able to sidestep regulation, which some call innovation and others say it's an arbitrage opportunity. And I guess it's
part of the reason why it makes DeFi so exciting, but also it makes a lot of people very, very nervous, especially when you compare it to traditional finance, which is, as we said, heavily regulated, strict compliance rules, all big institutions are kept in check, and so on. And I guess some people argue that DeFi's regulatory gray area gives it a bit of a competitive edge, whilst all others think it's like a ticking bomb. What's your take? Do you see the DeFi's ability to operate outside these traditional regulations as a sustainable advantage over traditional finance, or is it a vulnerability that could lead to huge setbacks in the future?
Probably both. I think the good thing about regulatory arbitrage and regulatory gray areas is that it allows people in crypto to just try things, to not ask permission, to just set up an exchange and see what happens. Like there's a new one called Hyperliquid, which it's got it runs on about 4 nodes in Singapore, which is effectively like a centralized exchange, except on crypto rails. And that would never fly with US regulators, but they're trying it, and that could, and it's popular, and maybe it'll get decentralized in the future or down the road or something like that. So yeah, I think the advantage of that gray area is that people in crypto can just try stuff, throw things on the wall and see what sticks. But there's not a lot in the industry that's genuinely permissionless, because that's just very hard. Like developers can be arrested, front ends can be shut down, and almost everybody in crypto, like 99.8% of crypto is, people using front ends, except for the bots and stuff. It's just very hard to develop something with full anonymity, and it's very hard for people to access DeFi code without some intermediary, making it a lot simpler for people. So I think the benefit of the regulatory gray areas is you can just try stuff. But if the industry wants to be, genuinely cypherpunk, and genuinely permissionless, and not have to, ask for permission from any governments, then it would have to go in a different direction, like that dark web direction that I just mentioned in the last question.
Yeah, which is definitely not what at least most of the people are looking forward to. I think everyone, to a certain extent agrees that if you want to have more institution adoption or wider adoption altogether, at some point you gotta compromise on something. And there's just no way around it. You'll have to get regulated.
I think ultimately there might be a more mainstream decentralized finance that has got official approval, and then there might be a small hardcore group of people that are truly cypherpunk and truly operate without anyone's permission.
So one last question regarding DeFi versus TradFi. It's a bit more philosophical. It has to do with education. So I have the feeling that decentralized finance markets itself as a solution for financial inclusion. Like we've all heard these slogans of banking the unbanked, creating access to capital, removing intermediaries. And in theory, all of that is great. But in reality, I feel that DeFi is, look, listening at you, we realize it is highly technical. It definitely requires a certain level of financial and technological literacy. And quite frankly, it can be super intimidating for the average person that is not willing to put like 1,000 hours into this. Whilst on the other hand, traditional finance, for all its bureaucracy, they do have infrastructure in place to serve people at scale, and most of it is relatively straightforward. So question for you is decentralized finance actually making finance more inclusive, or is it creating new barriers at a different sort of private elite group, so to speak?
Yeah, that's a good question. I think my answer again probably is both. for this one, I think it probably depends on the geography mostly. I think crypto has done an incredible job of promoting financial inclusion in countries that are suffering from hyperinflation, or where the government is very autocratic or something. But if you live in Argentina or Lebanon or something, and you have the option to opt out of your local currency by buying Bitcoin, or mostly people buy stable coins because ironically people just want dollars. But that to me is like a very important service, and that is a way in that crypto has really promoted financial inclusion. In the U.S. and developed economies, it maybe feels like it's the opposite. A lot of the times it feels like you have to be part of a cabal to make money as a crypto investor. Most of the money is made by being really, really early. The only way to be really early is to be in the right Telegram chat groups, and to be in, I don't know, the right Discord servers or something. I'm not in any of those. So I'm never super early. And that feels like financial exclusion. And there's also there's no reliable price discovery in crypto. If you're an equities investor, you can just go buy a bunch of stocks and be pretty sure that they're, within 10 or 20% of what they probably should be. And then you can make money by just waiting. Time is the ultimate arbitrage in equities investing. But you can't do that in crypto because there's, the price discovery is so scattershot that if you just buy a bunch of things, they could be, 1,000% overvalued. I guess that's impossible. They could be 100% overvalued. So I think that's my answer. I think there's a lot of financial inclusion for people who, can now opt out of their local banking systems and their local currencies. But for investors, it often feels like financial exclusion, as you said.
I love that sentence, that time is the ultimate arbitrage opportunity in traditional finance. It reminded me of that sentence of that says timing the market beats timing the market.
Yeah.
That's a good one. So wow, that was amazing. Like we covered so many different parts of decentralized finance. I learned a lot. Thanks for that. Now I have a couple last questions, but we're gonna go back to you as a person and your writing style. I want to ask you about the things you learned through writing, because I'm a creator myself, obviously at my own scale, I would say. So a lot less sophisticated type of stuff. I post just market insights related to market to financial markets on LinkedIn, and I realized that I learned a lot by writing, because you have to understand what you're reading, integrate it, and then actually try to explain it so that people understand it. And my question for you is, how has writing BlockWorks newsletter helped you refine your views about traditional finance, decentralized finance, and markets in general?
Yeah, that's a great question. I was an equities trader for 25 years, and I've been writing about crypto for 3 and a bit years, and I've learned 10 times more about finance in the 3 years I've been writing about crypto than I learned in the 25 years of trading equities. Part of that is because, in traditional finance, like every job is very siloed. It's kind of plug and play. You just worry about, your little tiny slice of the thing. You're not, if you're an equities trader, you're not like wondering about the Howey test. Like, is this thing I'm trading a security? Like, if you're trading it, it's obviously a security. But in crypto, you have to, force you to think about that, which is fun. And then, as far as learning through writing, like that's been like, a great experience for me. I've figured out that if I haven't written something, if I haven't written about some topic, then I probably shouldn't have an opinion on it. I do anyway. Like I, express lots of opinions still, but I'm kind of aware that those opinions are not very well founded. Because if you write about something, it forces you to challenge your assumptions, and it forces you to recognize that you're making assumptions that you don't even know that you're making. And, when I sit down every day and I start writing about a topic, I don't really know what I think about the topic until I've written it out. Like, I kind of find out what I think as I go along.
It's pretty cool.
And that's been a really fun and interesting process.
Like you're pushing yourself to the limit every day. It must be a little exciting, but exhausting at the same time. And
it's fun. Mostly it's fun.
Yeah, I think so too. Writing is really fun. And who are the authors or thinkers inside or outside finance that had the biggest impact on your style?
I don't know. I kind of people. You probably can't tell from this Zoom call, but I'm very tall. So people always ask me if I was good at basketball, and usually I say I was good at being tall. And if you ask me, like, if somebody asks, are you a good writer? I would say I'm good at sounding like myself. I think that's my skill as a writer, is that I'm good at sounding like myself. Mm-hmm. So I like to think that I just sound like myself, but, Matt Levine is an obvious influence. I hope I don't sound like Matt Levine. I don't try to, but I think Matt Levine very much sounds like himself. And his conversational style is something that I enjoy reading. So I guess I try to write that way as well.
He's one of the columnists in Bloomberg.
Yes, yeah, and he's like, sometimes I don't even think he's a real human being because he writes like 6,000 words a day. I have no idea how he does it. It's amazing. He's
I'll try to get him on the pod at some point, and we'll ask him the question from you.
Yeah.
Byron is wondering this. Can you please shed some light?
Are you a real person? Yeah. Yeah, he's amazing. But yeah, I like enjoy his conversational style of writing. So I guess that would be the finance person that I think of, and nice. I enjoy reading, so I probably have lots of writing influences that I'm not aware of.
So I have a final question for you that I'd like to ask to all the guests in the show. Again, a little bit more philosophical, but what's a financial lesson that you wish you had learned earlier in these 28, almost 30 years in finance?
That's a good one. I think probably it was the thing that we're just talking about, like time in the market beats timing the market. I think people just naturally take more risks when they're young, financial risks or risks of any kind. And that makes sense on the one hand, because, if you lose all of your money when you're 25, then you've got another 40 years to make it all back. And that's kind of how I looked at it early in my career. Like, I lost a lot of money in the .com bubble because I was just being silly and got caught up in it. But now, maybe it didn't matter because I was employed and I could keep making money. It didn't matter. But now when I think back and I look at just the value of, staying in the market over decades, I think people should probably think about it the other way around. Like they should be investing very conservatively when they're young. The power of compounding is really amazing. So yeah, I think maybe if I could impart a lesson to my younger self, it would be that thing about time in the market beats timing the market.
Yeah, no matter what you do, start. I mean, that's, I think, already like a good thing. Start investing, because a lot of people are intimidated and they don't know what to do, and they get paralyzed and overwhelmed. And at the end of the day, the sooner you start, the better. There will be good years, there will be bad years, but there's compounding, the eighth wonder in the world, as Einstein once famously said. Apparently, some people think he actually never said that, but I like to quote that. And let the compounding do its magic. Byron, it's been amazing. What a amazing conversation. That was great. Thank you for sharing all those insights. For those of you that are not subscribed to Byron's BlockWorks newsletter, please do so. I promise you won't regret. It's incredibly insightful. And even if you're not into crypto, you will read all those parallels between traditional finance and decentralized finance that Byron is so good at. And I can guarantee you are going to love it. Byron, thank you so much.
It's also free.
It's also free. There you go. Like, that's the ultimate argument. Byron, thank you so much for coming to the Blonde Dollar, and best of luck for the future.
Thanks for having me on. This was fun.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.